I think if rates go up a bit further, then I think two things. Obviously, there's the mathematical effect of a little bit more of a headwind from higher interest rates for the ratings of the equity market. There's also a slightly greater risk of a policy error, because I think in the US, I think there are clear signs that the worst of the inflation surge is over and it is moderating. Maybe not as fast as the market was, it may be discounting, as you commented earlier on. But I think once inflation's heading in the right direction, it's very easy for central banks to be a little bit more patient in the speed with which it converges with a sort of assumed 2% target. So I think if inflation is set to moderate, then in the US, I think in a month's time, the Fed's pause of last week is going to look even more sensible. Whether they do another 25 bips, I'm not sure, but my suspicion is that's slightly neither here nor there. In Europe, and particularly the UK, I think people have extrapolated recent disappointing inflation numbers and maybe over-egging the pudding in terms of how far rates are going to go. There are some talks of UK rates going up to 6% from the current 4.5%, and I think that overdoes the gloom for a couple of reasons. First of all, if you get two or three disappointing numbers, there's not a bad chance that the next number is neutral or even a little bit better than expected. There's also a big lag in the UK. A lot of mortgages were fixed for 2 to 5 years and are gradually going to be catching up with a much higher rate when they come to refinance. And that's big money being taken out of people's spending pockets. And so for that reason, I think quite a lot of the impact of the tightening we saw at the back end of last year is still to come through. The Bank of England almost certainly will move by a quarter, just possibly a half this month. But I think they would be wise to move in gradual steps, because I think over coming months, we're going to see more and more evidence of consumer demand cooling off. I think investment's going to be okay, because that's driven by other aspects like sort of decarbonisation, infrastructure, and maybe less positively defence spending. But I think there's going to be a marked weakening in inflation pressures in the UK over the balance of the year.
I wonder why market participants in the UK in rates markets believe that the UK is going to go ahead with up to 5 rate hikes this year, given the outlook that you just described. It seems so inevitable that if we're looking at rates at 5, maybe 6%, and you've got a number, I believe 1 million mortgages that are going to be up for renewal by the end of this year. What's the number? More than 1 million households due to refinance their mortgages this year. I mean, that's a tricky backdrop. Why do the markets think the UK is going to push through all these rate hikes?
Oh, well, if only the markets were always right in their balance between short-term and long-term drivers. I think there's understandably, the big story in the last 18 months has been inflation surprising on the upside worldwide and worse in the UK. And so if you get 2 or 3 numbers which are on the disappointing side, it's very easy to extrapolate that. The UK historically has been an inflation-prone economy. Everything looks a little bit messy politically and so forth. So I think the markets are overreacting to what has undoubtedly been disappointing short-term news, and ignoring the tightening that's already in the pipeline. I wouldn't minimise the problem. The UK is hoping to get inflation down to say somewhere between 4 and 5% by the tail end of this year. Well, that's worse than most other parts of the world, but it's a lot better than the 11% we saw over the first quarter of the year. So. My hunch is that by the autumn, the momentum of short-term numbers is going to look a little bit more encouraging for the idea that rates may be peaking. I think we're going to be seeing a Table Mountain rather than a Matterhorn. Rates are going to stay high, I think, in many parts of the world for a long period, if you like, to bear down gradually on inflation rather than to wallop it onto target in the next 6 or 9 months. I think I can't see any positive case for central banks trying to get inflation to target in the very short term, with the risk that by the beginning of 2024 or during next year, they'll then have to start cutting. What's the point in overdoing the tightening right now and then cutting possibly to offset falling inflation or falling prices in a year's time? So I'm hoping, which of course I could be wrong, and I'm probably no better at I'd be no better as a policymaker than the central banks, but I'm hoping that they will go for a prolonged peak rather than a short, sharp shock.